Then last but not least, we have Equinox Gold, who just announced the acquisition of Calibre Mining to become Canada's second largest gold producer. Rhylin Bailie, take it away.
Perfect. Thank you. So merger with Calibre, not an acquisition.
Merger.
Oops, sorry. I'm Rhylin Bailie. I'm the Vice President Investor Relations for Equinox Gold. It's my pleasure to be here to tell you how we are creating the premier America's gold producer. A few seconds to talk about me. I've been in the mining industry since 1995. I started my career at Placer Dome in the finance team, went and worked with Nova Gold Resources for 5 years doing investor relations, a few smaller resource companies after that, and I've been working with Equinox Gold since 2016. I was employee number 6 when we started this company. Lots of forward-looking statements today. My lawyers would kill me if I didn't mention that. So the company that you see in front of you today was started at the very end of 2017. At the time, we had a single asset in Brazil, and Ross Beaty, who is our chairman and our largest shareholder, he owns about 5.5% of the company. Ross Beaty joined us, and he wanted to build a big gold company, and he wanted to build it quickly. He wanted to build something that would provide superior leverage to what he thought would be rising gold prices. And he wanted us to be a major gold producer with a lot of gold in the ground. So if you're going to build something quickly, you have to do it through M&A. You can't do it through exploration and development. So we had a busy 7 years. So the first thing we did was bought the Mesquite mine in 2018. That gave us our first producing mine. We bought Leagold Mining in 2020. That gave us a mine in Brazil, 4 mines in Brazil and a mine in Mexico. We bought Premier Gold in 2021. That gave us our flagship Greenstone asset in Ontario, Canada. And then, as mentioned, in February of this year, we've announced our intention to merge with Calibre Mining. So that transaction will close probably in about a month. Along the way, we've also built 4 mines. We built 2 mines in mine in California and our Greenstone mine in Mexico. We've also sold 2 of our smaller mines, so we've been focused on optimizing the portfolio, and we've spun out some of our non-core assets to create 3 new companies: Solaris Resources, Versamit Royalties, and i-80 Gold. So it's been a busy 7 years, and you can see from this slide that our production has grown from 25,000 ounces in 2018 to about 700,000 ounces of gold that we expect to produce this year. But the merger with Calibre Mining is going to increase that. Our combined guidance for 2025 with Calibre, that's using the midpoint of our guidance and the midpoint of their guidance, will see us producing about 950,000 ounces of gold this year. So an immediate bump to production at all-time high gold prices. But the real thesis behind this transaction was to get those 2 big Canadian mines together under one company. So we've got our big Greenstone mine in Canada, in Ontario. That's going to produce around 400,000 ounces a year. Calibre's building a new mine in Canada in Newfoundland called the Valentine Gold Mine. And when we put those 2 mines together, that's going to give us 590,000 ounces of production per year coming from Canada. And the reason that's important is because Canadian producers tend to trade at a premium in the market. If you look at this slide, you can see that Alamos, Wesdome, Orla, New Gold, all of those companies are trading at a significant premium to their peers, and it's because their production is coming primarily from Canada, which is considered a safe Tier 1 jurisdiction. So we realized if we put Greenstone and Valentine under one company umbrella, we would hopefully get that market re-rate as a premier Canadian producer, and then, of course, as mentioned, we get that immediate bump to production, which is fantastic. You want to maximize your production when gold is at all-time highs. So at the back of this transaction, we'll have 7 producing mines. We'll have the Valentine mine in construction, and it's on track to pour gold in Q3 of this year. We'll also have 5 expansion projects that I'll talk about briefly. So we'll not only have close to 1 million ounces of production right out of the gate, but we've also got another 500,000 ounces of production built into our portfolio that we'll deliver over the next few years. We'll also have a big gold endowment, 23 million ounces of gold reserves, an additional 22 million ounces of gold resources, and all of this is diversified in 5 different countries. And that diversification is also important to protect our shareholders from geopolitical and other risks. So we're super excited about this transaction. You can see the immediate benefits, production growth and EBITDA growth. So in the middle chart here is using analyst consensus gold prices of $2,780. They expect that production will grow, EBITDA will grow from 500 million ounces, which is what we delivered in 2024, to $1.8 billion this year. And if you look at spot gold prices, so using 3,200 gold, they expect even more EBITDA growth, growing to over $2 billion this year and close to $3 billion next year, with both Greenstone and Valentine fully ramped up. So a lot of growth to come, and of course that allows us to improve our balance sheet. So we have been building the company. obviously through M&A, through construction. Now we're at this real tipping point where we've gone from growing and spending money to actually tipping over the top and starting to make money. So it's an exciting opportunity. We significantly increase cash flow. All of that's going to allow us to quickly pay down our debt and improve that balance sheet. And then, of course, that lets us look at other opportunities in the industry. So our objective is to be at less than a 1 times debt to EBITDA ratio, probably in this year, certainly early next year. The other benefit of combining these two companies is the strength of the two leadership teams. So Greg Smith is currently our president and CEO. He's an accountant, so he's obviously very good at cost controls, corporate governance, capital markets, M&A. Darren Hall, who is Calibre's president and CEO, is a mining engineer. His expertise is in asset optimization, exploration, discovery, sustainability. Those two men are going to come together and run the company together. So Greg will carry on as the CEO. He's giving the president title to Darren, and Darren will be our president and chief operating officer, COO. So I think that's a real strength for the company to have two people at the top. We're going to have a lot of mines. It's a big company. We're going to be a US $5 billion company on the back of this. Now you've got two people who are at the top running that company together. Each of them gets to focus on the things that they're best at. Neither of them is stretched too thin. And you've got somebody that's at the same level that you can brainstorm with, share ideas, strategize. So I think it's going to be a real strength for the team to have Darren joining us. I'll talk quickly about the assets. So Greenstone, that's our Canadian cornerstone asset. We bought it in 2021 when we bought Premier Gold. We spent about 2.5 years building it, put it into production on time and on budget in 2024. I think we were the first company in probably 15 years in Canada to build a project on time and on budget. It became commercial production at the end of last year, or in November of last year. So it's still ramping up. Our guidance for Greenstone this year is 300 to 350,000 ounces. When it's ramped up to capacity, probably Q3 or early Q4 this year, it will have that run rate of close to 400,000 ounces a year with all-in sustaining costs around $1,000 per ounce. So as Greenstone ramps up quarter over quarter this year, you'll see our production increase, our costs come down, and then we'll have that nice 400,000 ounce run rate for a while. Very big mine, 15-year mine life, good grade, almost 6 million ounces of gold in the ground, and lots of opportunities to both increase production and extend the mine life. So right now, design capacity is 27,000 tons per day. We've run the mill at 30,000 tons. We've got the equipment and the permits we need to do that. There's also almost a 4 million ounce underground deposit that will absolutely come into the mine life at some point. It's not currently included in any of the mine economics, but when we get into the underground, now you're talking a mine that's going to operate well longer than 15 years. So things to watch for at Greenstone, I said, is that ramp up quarter over quarter this year, and then being at capacity and those lower costs later this year. Valentine is Calibre's flagship asset, so they've been building it for about a year. It's on the cusp of production. It should be pouring gold in Q3 of this year. It's a smaller mine than Greenstone. It's going to produce around 200,000 ounces a year, around 7,000 tons per day versus Greenstone's 27,000 tons per day. So it should ramp up more quickly, and we're hoping that Valentine will be at capacity probably early next year. Again, all-in sustaining costs are around $1,000 per ounce. So with the additional production growth coming from Greenstone and Valentine, you'll see our consolidated costs come down quite significantly next year, which of course makes us a much more attractive and investable company. Another nice long mine life here, at least 14 years, opportunities to both increase production and extend the mine life. So these are going to be our two big flagship assets going forward. Calibre also has some Nicaragua operations. It's a bit of a different business model. They have 2 mills, and then they actually truck ore from around the country to those 2 mills. It's called a hub and spoke operation. It's been very profitable, produces around 200,000 ounces a year. They've had excellent exploration success, and I expect that to continue. At our Brazil operations, we have 3 mines in Brazil, the Aurizona mine, our Bahia complex, and then a smaller mine called RDM. Collectively, those assets produce around 275,000 ounces of gold per year. So those are all the operating mines, but then I said we've got the additional growth built into the company. So this year, Greenstone's guidance is 300 to 350. Next year, when ramped up to capacity, it's 390, so you'll have 65,000 ounces of production growth coming from Greenstone in the very near term. There's no guidance from Valentine this year, so that at the moment there's nothing guided for that, but it will be in production in Q3, so you'll get a little bit of production out of Valentine this year, and then close to 200,000 ounces next year. Our Arizona mine in Brazil, we're doing an underground expansion, so we'll start building that underground portal probably late Q3 or early Q4 this year. That will add 60,000 ounces coming from Arizona in the next couple of years on top of what it's already producing. And then this big mine that we're going to be building in California, so it was in operations historically. We're in the permitting process now to do a big phase 2 expansion. That's going to take production to 220,000 ounces a year from that mine in California. Again, another big producer, long life, low cost mine. So all of those mines collectively will add close to 550,000 ounces of production growth over the next few years on top of that 1 million ounces that we're already producing. And of course, the hope with all of that is that as our production rises, we'll see our valuation rise as well. Right now, Equinox Gold is trading at a discount to our peers, partly because we've been building Greenstone. We've been in that big capital-intensive growth phase. Like I said, now we're at that tipping point where the growth is behind us. No big capital projects coming up. All we need to do is get Greenstone ramped up, get Valentine into production, and that's fully funded. And now we tip over the top into that cash flow phase. And you've got the increased production, the increased cash flow, lower costs, lower equity execution risk, increased liquidity. We've been trading 20, 30 million shares a day on the back of this transaction. Hopefully that will continue. A much longer average mine life and all of the enhanced jurisdiction of being in these mining-friendly American companies. Of course, we're doing all of this with gold at all-time highs, which is fantastic. You've seen the gold price rise over the last few months. Everybody was calling for higher gold prices. I don't think anybody thought it would rise quite this quickly. It's been extraordinary, hit a record high of 3,500. I heard it pull back a little bit today, but certainly we're happy to have gold in these ranges. And I think I often get asked the question of at what point are the generalists going to come in? We all know that gold is a tiny point of investment in the investment world. About 1% of global investments are in gold, and just a small uptick from the generalists coming to look at the gold equities will make a significant difference. My personal feeling is that with so much volatility in the gold price, I think that would be a little bit scary to a generalist investor, but if gold stabilizes, I should think we should start to see them coming in and looking at gold as a safe haven investment with all the global uncertainty. And the other question we get is, with gold prices so high, why have the equities not been keeping up? And I think we'll see that gap start to close as well. Year to date, gold's up about 22%, the GDX is up 32%, so the equities are starting to make up that difference. And the key catalysts that are going to attract those generalist investors is higher gold prices, obviously, but they'll be looking for companies that have a strong balance sheet or are deleveraging, like we will be. They'll be looking for companies that can offer some growth. We offer 550,000 ounces of production growth over the next few years. They'll be looking for a company with costs that are coming down, that are diversified, that have multiple mines in multiple countries to give that diversification protection. So I really do feel like Equinox Gold should perform very well in 2025, just by virtue of the things that we're working on already, but then exceptionally well if gold prices continue to rise. So why are we doing this merger? We really do feel like combining Equinox Gold and Calibre is going to unlock benefits beyond what either of these companies could achieve on a standalone basis. We'll get that enhanced capital markets profile. We'll be a US $5 billion company on the back of this transaction with all of the benefits that attracts from the big institutional investors. We'll be in 5 mining-friendly jurisdictions. We'll own 100% of those 2 big Canadian gold mines at the very beginning of their mine life. The Canadian production will be more than half of our asset portfolio. The immediate increase to production and cash flow in the record gold price environments. Lots of improved financial strength. We'll be quickly paying down our debt, and that allows us to more quickly start returning capital to shareholders. So we do want to start looking, now that we've at this point of going from growth to cash flow, of, do we return capital to shareholders with share buybacks, a dividend, or possibly both, and that's on the very near horizon. I think we have a fantastic leadership team with Ross Beatty at the helm. The 2 main directors from Calibre are also coming to join us, and then Greg and Darren running the company as the president and CEO. Lots of efficiencies and synergies by bringing these 2 companies together, and then all of the growth exposure that we offer to investors with Greenstone and Valentine ramping up, Castle Mountain, and then the other development projects in the asset base. So that's a quick synopsis of Equinox Gold. I do have time for questions, and then of course I will be here very quick. I know I talk quickly. I will be here to answer any questions as well during the reception tonight.
Thank you, Rhylin. Are there any questions?
Sure.
Sure.
What's your ASIC?
Right now our ASIC is around $1,500 per ounce. That will come down as Greenstone and Valentine ramped up, because those will be our biggest producers and also our lowest cost producers. Both of those mines will be about $1,000 per ounce. Longer term, 5 years from now, are hoping that our production will still be well over 1 million ounces a year, and that our all-in sustaining costs will be in the lower half of the industry. Yes?
Are you paying or earning dividends?
We're not currently paying a dividend. We've been busy growing the company, but since we started the company at 2017, we promised that we would pay a dividend eventually. I think once we achieve our million-ounce vision and we're cash flowing, which is just a few months away, then we'll start be looking at a dividend, maybe this year or early next year. Question at the back?
Thank you. I have never understood, for example, if the ASIC goes down, but when the gold price goes up, don't your other material costs also go up? I mean, why should gold go up? Only gold go up, so to speak.
Yeah, we've certainly seen gold prices rising at the same time that inflation has been going up. We've seen the inflation stabilize to a certain extent. Diesel costs have come down. Some of the consumables have come down. What tends to not come down in those inflationary environments is labor. Once you've sort of set the salary, you know most people don't want to take a salary cut. So you see some of the consumables come down. Labor stays flat. So certainly the margins have been increasing with the gold price rising. So you see a lot of mining companies are appreciating a pretty significant margin.
Last question, yeah.
What is the percentage of your cost is fuel, broadly speaking?
Oh, geez, I'd have to go pull up my financials. It's a fairly significant cost. We do obviously try to be as efficient as possible. One of the things that we've actually introduced over the last 2 years is an asset optimization program. So we have a vice president of continual improvement, and his job is to try to capture cost efficiencies at the mine sites to make sure that we're reducing our costs as much as possible, improving our operational efficiencies. One of the things he's been looking at is reducing fuel costs. So if you can make sure, for example, that the haul trucks are always loaded to capacity, that you're maximizing their uptime, that you're being clever with which truck's going where, so you're reducing haul times. All those things are things that we've been implementing, and we've actually managed to capture back about $50 million in EBITDA last year and this year just through those efficiencies.
Thanks, Rhylin. I'm
Pleasure.
sure you're available for any other questions.
Absolutely. Thank you.
Thank you.